Hi everybody, this is Chris from TPLI Turning Point Life Investment. This is going to be a video about common thinking errors, a couple of them that traders make every day. One of them is going to be about if you get stopped out, if you're close to stopped out and you hold through the pain while you're doing that. And the other one's going to be about if you buy something or sell something and you get stopped out, is it a good time to reverse the position? So we'll go into our first topic. It's going to be about being in a trade, and then what do you do about thinking while you're in the trade? One of the things that I always love to hear is how they talk about you can't. It's easy to see what's going on in the middle of the chart, like it is here, but we have to trade on the right side of the chart. So you can see what happened back here, but you can't trade this, and you can only trade the right side, and you don't really know what's going to happen. You just know the probabilities of what's going to happen on the right side of the chart. So I'm using SPUX Starbucks as an example. This is going to be great right here, where you see this Starbucks had a nice consolidation, a nice run up in an uptrend, and then had a nice consolidation. Like you can see right here. Now this white candle on pretty high volume, white candle, it broke out to new highs. So let's say you bought that because it broke above 31, and Starbucks is going to continue up higher. And in the next 2 to 3 days, it comes back into the range. Now, a lot of people have rules where if they buy it on a breakout and it returns back to the range, they're going to exit. And that's a pretty good rule of thumb. Now, see, the thing is here is that let's say you exited, it came back in the range, and then it made this nice pop up, and then all you're going to say to yourself is, man, if I could have held through this downwards movement, through this selling, I could have just held on to the ride, and then it would have moved up. Now, that's one of the things that's it's very harmful for traders to have, especially when you're trying to trade on the right side of the chart. We're going to take a look at another example using Weight Watchers. I'm just going to zoom in. Here's a nice box range, and it actually had a breakout above the box range. I know it's a small box range, but this is just a nice example. Volume kind of picked up a bit, and then it broke out above the box range, so you're going to say, hey, you know what, I'm going to buy. Alright, and using the last example, even if it turns back in the range, hits the bottom of the range, I'm just going to hold through it and hold through the pain because I know I'm going to get rewarded. So keep going, and then the next day after the breakout it sells back down, but then you're still saying, hey, you know what, even though this was a drop from like 83 to 80 or even 79 something, like a 3 or 4 point drop in one day, I'm still going to hold this because I know that I'm going to be rewarded for my pain of holding it, even let's say it went past your stop. And then let's go see what happens the next day. Okay, nothing the next day, and then another down day. So it's really close to $77, and you entered at 85. And then just to keep saying over and over, hey, you know what, I just have to hold through this, and it's going to recover. And once it recovers, it's going to hit my highs. I mean, like, no, once your stop is usually hit, you're just going to get out. You're not going to be wishing and hoping and saying, hey, when it recovers, I'll be fine, because this Starbucks just continued to go down to, let's see, where's it at today? $73.97, and you got it at 85, 86 something. Yeah, that's like a $12 loss. I mean, you can't just be constantly thinking you're going to be rewarded for your pain. Big Lots was a great example. It had this huge run up from like 31 something to all the way to 44. Huge run up. So everyone was saying, oh, on the pullback, just buy. On the pullback, just buy. So let's see, let's say FDO had this nice pullback to the 50-day exponential moving average, and you're like, hey, you know what, you wanted to buy at this level. Let's see, I'm going to say around this area. See, I like to look at charts raw and then try to figure out what we do at the right side of the chart. So this area right here, FDO, nice run up, pulled back to the 50-day exponential moving average and say, hey, you know what, I want to buy. My stop's going to be like right underneath this area, and I'm expecting it to move up to even new highs. So, you know, as time goes on, boom, you know, okay, it stops you out right here and it breaks under $40. And then you say, oh, you know what, I'm just going to hold. FDO's still in a nice uptrend. When it recovers, it's going to move up higher. Not FDO, Big Lots, BIG. So you're like, okay, I'll just wait, hold it. And then, you know what, it doesn't come back and recover and ends up selling even lower, even back to where it had this nice run up. So it's really rough when you're trading like that, but it's usually just better to have different scenarios play out in your head of how the trade's gonna go, and then figure out which plays are what odds each play has, each scenario has, and then if the trade that you want has the odds with it, then you're gonna take that, and then always have your stop, because you know, looking at all these examples, you know, once it hits your stop, if you don't get out, you could be in a lot more pain. The next thinking error I want to get into is reversing your position once you get stopped out. A lot of people like to do it or think about it, and that's one I do try to avoid. We can use the same example right here where you were going to buy on the pullback to the 50-day exponential moving average with your stop right underneath it. You know, this would have worked out, but you never know. So you say, hey, you know what, I'm going to buy, stops right here, and then you get, you know, stopped out a couple days later, you reverse it, and you go short. Now this would have paid off, but normally, I mean, there's no way you could have predicted that this was going to happen. So I really view it, in my opinion, of my trading, I just view it as a big gamble. Let's look at FDO as another example. There's this nice breakout that it formed. Or actually, let me go in a little bit more, because there's actually a trade that I took was right here on FDO when it pulled back to the 20-day exponential moving average, and then there's this prior resistance level right here. So resistance, moved up, pulled back, retested it as support, so I bought it. And it pulled back to the 20-day exponential moving average, so I bought it, and then it stopped me out. So let's say you're like, okay, you know what, it stopped me out, I was long, now I want to go short. So let's say you would have shorted this position, and then, you know, it would have moved down a bit, and then continue side trending for a bit, and then hit new highs. So, you know, it's really rough to reverse your position, you know, and then this is where another thinking error goes, oh my gosh, if I would have stayed long and through this pain, it would have happened and recovered to a new high. But like I said, you know, you don't really know what's going to happen on this right side of the chart. All you have is right here and the probabilities of what's most likely to happen. You know, I can use Walmart as another example where I had this nice breakout above $53. Right here on a white candle, volume is decent, white candle breakout. So it moves up, and then, you know, it starts to move down, so it stops you out. And then if you would have waited through all the pain, it would have went up higher. So it's just, you know, you could have done that, but then at the same time, let's say it moves up, moves back down under the breakout level, hits your stop, and then you want to reverse it and say, hey, you know what, I'm going to go short. It's my time to go short. So you go short, and then it moves up. So there's always this battle that's going on in your head, and you're like, oh, you know, you don't really know what's going to happen in this area after you buy on the breakout. That's why you have to have stops. And then you have the scenarios of what's most likely going to happen. I mean, you know, if you're right and it's like a true a true, like, I'm just using breakouts as an example, but if it's like a true breakout, it really shouldn't go back in the range. There was this nice breakout here, and instead of just continue to march up higher, it didn't move back in the range. But it depends on your style, and you just have to know the scenarios of what's most likely going to happen. This is just a video to show you of some thinking patterns or errors that I try to avoid when I'm looking at charts and doing my trading each day. If this has helped you, I hope it helped. And if you have any questions, feel free to email or comment. Thanks.